Good afternoon, everyone. Welcome to today's OptionsPlay webinar. Today's topic is covered calls. My name is Scott Green, Marketing Director with Regal Securities. Shortly, I'll be introducing our main OptionsPlay presenter, Tony Zhang. Today, covered calls using OptionsPlay, we'll be going over what are covered calls, implementing a covered call strategy, and analyzing opportunities for covered calls. For those who are new to OptionsPlay, it's a tool that's highly integrated with your trading platform. It was recently relaunched with improved analysis, strategy, and research for trading options. And after I introduce Tony, he'll be going over all about the covered call strategy. And then afterwards, we'll have time for your Q&A. Tony will show that we usually handle the Q&A just in the chat boxes, which we'll be addressing after the presentation. First, I just need to share our disclaimer. The types of securities forms and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell an option. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. Now, I just want to introduce the great Tony Zhang, the Chief Strategist at OptionsPlay. He's been doing our OptionsPlay webinars, and he has 12 years financial services experience. He oversees the development team at OptionsPlay, and they've led to some of the most innovative tools in options trading and analysis. The OptionsPlay tool is currently embedded with several major sell-side brokerage firms, as well as a direct-to-consumer platform. Tony has helped build up this product suite for bringing it both to market, and he's developed and managed many of the OptionsPlay partnerships. So once again, those who haven't used OptionsPlay before, when you're logged into your platform, it's a tab across the top. You can find it right there. If you're having any difficulty either logging in or finding your OptionsPlay tab, please contact your brokerage customer support, and they will be happy to help you address the situation. So with that said, Tony, I'll let you take it away.
Thank you, Scott, and thank you everyone for joining me this afternoon. Let me just share my screen here. Okay, let's go ahead and get started here. So today, we're going to be talking about how to generate consistent income using weekly options. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. This is one of my favorite topics simply because it's a topic that's applicable to almost everyone. If you own any stock in your account, you can sell covered calls to generate some additional yield in your portfolio. So even if you are relatively new or brand new to options trading, this is one of the easiest and best ways to get started with options trading. So regardless of whether you're experienced with options trading and you're here to help and you're here to learn something new, or if you're brand new to options trading, I hope this kind of inspires you to start taking a look at options. What I will spend a bit of time talking a little bit about is the best practices for how to use cover calls to generate income for your portfolio. However, what I'm going to show you guys here today, not only the methodology, but also the platform that I'm going to show you is applicable to all different forms of income generating strategies. So for those of you that have some experience that want to sell cash secured puts or even credit spreads, our platform is designed to allow you to quickly find those opportunities for your portfolio. Now, how many of you are familiar with cover call strategies? If you are, please type yes into the chat window. And if this is a relatively new strategy for you, please type in no, just so I get a feel for who's in the room. Okay, so quite a few yeses, but also at the same time, quite a few nos, and that's great. So today, for those of you that are brand new to cover call strategies, welcome. I really hope that this webinar not only informs you of what they are and how to utilize them, but more importantly, how you can utilize the tools that are available to you to actually implement some of these strategies instantly once we're finished with this webinar. That's really the goal here of OptionsPlay, is to not only teach, but also provide provide the platform or the tools that allow to facilitate you to actually do the research yourself and start doing these trades. And it's fully integrated into your trading platform, so it's designed so that it's as easy as possible for you to go from idea to execution. So today what I'll do is I'll cover a few different things. Number one, I'll talk about what is a cover call. This is for those of you that are brand new to this strategy, what it is, why you should consider using it. And lastly, how can you generate consistent income using this strategy? And what I want to spend most of my time in today is actually showing you the platform and walking you through real examples with stocks that you probably own in your account and showing you how you can instantly find cover call or income generating opportunities for the stocks that you own in your portfolio. And then lastly, what we'll do is we'll come back and we'll do a quick summary on kind of the exit strategies, meaning once you're in a cover call, how do you manage those strategies? So this is one webinar in our multiple webinar series. This webinar is recorded so that in the future, if you want to reference these, you have the recordings to look back on. So if you're brand new to options trading, don't expect to learn how to trade options from a single video, but we do have a lot of resources here available to help you educate you on options trading and specifically on getting started with cover calls. So first of all, let's cover what is a cover call. It's very simple. One of the reasons that this is the most popular trading strategy with options traders is the fact that almost everyone that has an options agreement should be able to place this trade, because what it does is it takes your existing stock position. So if you have any stocks in your account that you want to hold on to because you think the stock's going to appreciate in value in the long run, you can take that position and you can sell a call option against that stock position. And what that does is it generates income for your portfolio by selling call options against the stock that you own in your account. So for those of you that are brand new, buying a call option gives you the right to buy a stock. To sell a call option means that you have the obligation to sell the stock to someone else at a predetermined price in the future. And that's really what we're trying to figure out, is what is that predetermined price you want to potentially sell your stock at. And that combination of the stock that you own and the cover and the stock and the call that you've sold against the stock that you own is what's called a covered call. It's a call that you've sold that's covered by the stock that you own in your portfolio. So why should you do this? Number one, selling a cover call generates consistent income for your portfolio. Options expire. So every single month or every single quarter, however frequently you sell your covered calls, every single time that call expires, you collect that income and you can sell another call against it. And what that does is it lowers the volatility of your portfolio, and it also lowers the net cost basis of the stock that you own. So if you have a $100 stock and you receive 50 cents in income this month and 50 cents in income the next month, you've reduced your $100 stock cost basis down by $1. So if you continuously do this for a period of time, you can lower the net cost basis of the stock that you own. And the best part of cover calls, and this is the reason why more than 50% of options volume is in the single strategy alone, is because it's used in the existing stocks in your portfolio. This is the only option strategy that you can trade that doesn't add additional risk to your portfolio. Any other option strategy you trade, there is additional risk. This one actually reduces risk in your portfolio. So that's one of the reasons why it's one of the most popular strategies. It's also why it's a strategy that you're approved for when you first apply for an options trading account. However, there are some limitations to this strategy. So number one, it limits the upside return of the stock that you own. You own a stock because you believe that it's going to increase in value over a longer period of time. So when you sell a cover call, you are limiting the upside return of your stock. So it's really important to figure out exactly where you want to sell your stock or what strike price you want to sell your stock at. And we'll talk a little bit about that in the next few slides. So it's really important to understand where you sell your stock and how that impacts the upside return of your stock. This strategy does require at least 100 shares of stock in order to sell one contract of a cover call. So if there are some stocks that you have less than 100 shares of, this is not a strategy you can deploy. And lastly, you do risk selling your stock, because when you sell that call option, you have the obligation to sell your stock at a predetermined price in the future. So it's really important to understand when that predetermined time is and what that predetermined price is. Once you have those two set, which we'll talk about in the next few slides, that's how you're going to be able to understand how much income you receive and how much you're limiting the upside return of your stock. So based on that, how do you actually generate consistent income for your portfolio? And the first thing to understand about covered calls is that it's not a one-size-fits-all strategy. So generating consistent income will mean different things to different people. So first off, what we want to establish here today is understanding what is the suitable expiration date and strike price based on your personalized preferences. So we talked about selling a covered call means that you have the obligation of selling your stock at a predetermined price and a predetermined date. That's what the expiration date and strike price reference is, the date and the price you have to sell your stock at sometime in the future. And where you choose your expiration dates and what you choose your strike prices is based on your personal preferences. And that's what we're going to spend our time learning about, is what are those personal preferences and how do they affect which strategies you choose. And once you have those preferences, it's really easy to understand how to generate consistent income. It's really just simply applying the same methodical approach each cycle. So if you're doing monthly calls and you want to apply the same methodology month after month. If you're doing quarterly calls, you want to apply the same methodology quarter after quarter. So one of the things that I've been a strategist for the last 12 years working with clients from just about every single trading asset class under the sun. And the one thing that I find that helps clients build consistency into their trading and help them apply the same methodical approach month after month, quarter after quarter, really is automation. Because with automation, you remove a lot of the emotions out of the process of placing a trade. And that's really what I want to hopefully convey to you guys, is how OptionsPlay can help you generate consistency through the automation that we do. And the automation is two things. It helps you gain consistency, but more importantly, it's designed to save you time. If any of you have sold covered calls before, it doesn't matter whether you're selling weekly, monthly, or quarterly calls, you'll know that it takes quite a bit of time to go through the option chain, look for the right expiration, look for the right strike price. Not only by doing it manually do you open yourself up for your emotions to mistakes, but also it just takes a lot of time. So by automation, we're gonna be able to help you achieve consistency and help you shave the research time from a few minutes down to a few seconds. And that's what we really hope to show you guys here today. So like I said, there's two things that you need to select when you're selling a covered call. First thing is expiration. So let's talk about expirations. So here I have three buckets up here. We have active traders, casual investors, and buy and hold. So before we move on, we just have to ask ourselves, which one of these three buckets do we think we fall under? So I myself, as someone who trades fairly actively and I have time to look at my account every single day, I fall under the shorter end of the spectrum as an active trader. So when I'm looking for expiration dates, I'm looking for usually short-dated options or weekly options, anywhere from 21 to 49 days out. So anywhere from 3 to 7 weeks out is roughly the time frame that I'm looking at when I'm selling options for a covered call or a cash secured put or a credit spread. So today, I'm going to be talking only in the context of covered calls, but many of you that are a bit more experienced that trade cash secured puts or credit spreads, you can use this same template for those as well. On the other end of the spectrum of active investors, we have buy and hold investors. So many of you, or maybe not many of you, but some of you buy and hold onto your stock for months, if not years at a time. So you would fall on the longer end of the spectrum. You might sell longer dated calls, anywhere from 90 to 180 days, so monthly options. And then many of you may fall somewhere in between. You may not have the time to look at your account necessarily every single day, but you might look at it every few days or at least once a week. Then you're looking at perhaps medium-term expirations, anywhere from 50 to 89 days out. So this is usually 1.5 to 3 months out. Those are the type of expiration cycles that you would be looking for. So before we move on, make a mental note to yourself. Which one do you fall under? Because that helps you determine which expiration dates you would typically start off with when you're searching for these income opportunities. So let's talk a little bit about these three and how do they affect the income that you receive. So when we sell short-dated options, when we're selling weekly options, we have a fair amount of certainty in terms of what's actually going to happen between now and expiration, because it might only be 3, 4, 5 weeks away. We know if there's an earnings coming up, if there are dividends coming up, perhaps if there's a product announcement that's about to come out, we have a fair amount of visibility into what's going to happen over the next few weeks. Versus someone who's selling a 3 to 6 month option, you have a lot less certainty. You may not even know when that next earnings date is. You might not know when the next dividend's coming out. You certainly may not know when news announcements or product launches may be coming out. Those things tend to be just announced a few weeks in advance. So you have a lot less certainty. So what that means is that when you're trading short-dated options, you're going to have less income. When you're trading longer-dated options, you're going to have more income. So we're going to learn a little bit more in the next few slides about how that actually affects your strategy. However, most users will tend to be more on the shorter end of the spectrum as active traders and trade what we consider weekly options, so anywhere from 3 to 7 weeks out. Next, we want to look at selecting a strike price. So now that we've figured out which expirations we want to look at, next thing we want to figure out is what strike prices to select. And here you have effectively, your strike selection should be based on your own risk tolerance. So each one of us is different. So it makes sense that for us to understand what the different risk tolerances are in order to select the appropriate strikes for our risk tolerance. So someone on the conservative end of the spectrum when it comes to risk tolerance, this is for those of you that own stock you've held on to stock for a long time. Perhaps you have a low cost basis on that stock and you don't want to lose this stock because you plan on hanging on to this for a long time. Or for those of you that perhaps have a dividend income that you rely on those dividends as income, and you want to make sure you retain those stocks, and you want to make sure you don't sell those stocks, you would fall under the conservative end of the spectrum. So for those of you that are on the conservative end of the spectrum, you would sell what we consider 10 delta calls. So we always use delta to determine our strike prices because delta gives us a proxy for probability, because in order to gain consistency, we want to use probability to help us select our strikes, because probability accounts for things like news announcements that are about to come out, volatility and all of that. It accounts for those things. So it automatically adjusts how far these strike prices are away from the current stock price based on news events and things that are about to come out. On the opposite end of the spectrum, for those of you that are aggressive or trying to chase yield, meaning you don't care if you lose, if your stock gets sold, you're okay with that. You just want to get the most amount of income, the most amount of yield possible. You would fall into the aggressive end of the spectrum. For those of you, you would use a 30 delta call. And then for those of you that are somewhere in between, such as myself, I'm not too conservative, I'm not too aggressive, I'm somewhere in between. I would consider myself optimal, not too aggressive, not too conservative. I would use a 20 delta call to select, or I would use the 20 delta call as a strike for my selection. So what does the 10, 20, and 30 delta call mean? So when we talk about a 10 delta call, that's referring to a call that has about a 90% chance that call will expire worthless, or about a 90% chance that you keep all of the income from that call. A 30 delta means that you have about a 70% chance, and a 20 delta call means you have about an 80% chance. This is how you gain consistency, because if you're choosing a 20 delta call every single cycle, then you know that roughly 4 out of the 5 cover calls that you sell, or 8 out of the 10 cover calls that you sell, you're going to be able to collect all of that income, and on 2 out of the 10 trades that you make, your stock will get sold off at the strike price that you selected. So this is really where, when we talk about gaining consistency, is using strike prices based on delta in order to pick our strike prices so that we can gain consistency. And we've tested this over the last 10 years across the S&P 500 stocks to see how accurate delta is in understanding whether or not you keep your income. And delta was surprisingly dead on in giving us the probabilities of us keeping the income for strategies like cover calls. But they also apply for cash secured puts or credit spreads or whatever other income strategies you might trade for those of you that are a bit more advanced. So when we're talking about conservative strikes, these are 10 delta calls, or calls that have very low probability of the stock being sold at that price. So these are higher strike prices based on the current price. This gives you stock. This gives your stock a lot more upside room to run before your stock gets called away. In exchange for that, you're going to get less income. Conversely, for someone who's very aggressive, is going to sell lower strike prices, so strike prices much closer to the current price of the stock. This gives your stock a lot less upside room to grow before your stock gets called away. In exchange for that, you're going to get more income. Okay, so that's how you kind of look at the different expiration dates and strike prices. So before we move on, make a mental note to yourself, which one do you fall under in terms of expiration dates, short, medium, or long term? And then for strike prices, do you fall in the conservative, optimal, or aggressive? So again, my preferences are short term because I'm fairly active with my trading, and my risk tolerance is optimal because I'm not too aggressive, nor am I too conservative when it comes to these strategies. So remember that, because we're going to come back to that when we're using the platform to help you find the optimal cover calls for your personal preferences. So now that we've gone through looking at picking expiration dates and strike prices, now let's say you follow all of those things to a T. How do you know if you're getting enough income? Because you can find those, let's say you're a short-term optimal trader, so you search for that 30-day option, you search for that 20 delta strike, and then you see that the option's trading at $1, or it's trading at 5 cents, or it's trading at $10. How do you know you're getting enough income? And the easy answer actually is to simply compare the cover call yields to the dividend yield of the stock. And if you're asking, how do I calculate cover call yields? Don't worry, OptionsPlay actually does the calculation for you. So you don't have to do any math on your end. We will actually display to you the cover call yield. All you have to do is compare it to the dividend. And the rule of thumb that we have here is make sure you beat the dividend yield with your cover call. That's how you determine, am I getting enough income? So I have 3 examples here. I have 3 examples. One, I have a stock or a cover call that I'm looking at that pays a 3% yield on a stock that pays currently only a 1% dividend. This is where you beat the dividend yield with your cover call. That's why you get a green check mark. These are the types of opportunities that you're looking for, because this is a stock that you're only earning 1% on. Now you're going to increase that by an additional 3%, bringing your total yield to 4%. You've increased your yield from 1% to 4%. That's exactly what you're looking for, okay? The second example here, this is kind of our bare minimum. So you have a stock that pays a 3% dividend, and you're looking at a cover call that also pays a 3% dividend. This is kind of your bare minimum. This is what you need to get in order for it to be worth your while, because you have the risk of potentially selling your stock. You need to be compensated for that risk. And based on the dividend yield tells you whether or not that risk is worth it. Lastly, I have an example where you have a stock that pays a 3% dividend, yet you have a cover call that only pays a 1% yield. This is the type of opportunities that you want to avoid, because you currently are already getting paid 3%. Don't take that additional risk of having the stock being potentially sold for only an additional 1% yield, okay? So that's how you use dividend yield and cover call yields to determine, am I getting enough income? Because a lot of times when you're looking at those option chains and you see all those pricing, you have really no idea based on that if you're getting enough income or not. So using the yield is how you actually calculate that. So if you follow all of those things that we talked about, what we did is we back tested all of those short, medium, long-term calls, conservative, optimal, aggressive. And what we wanted to see is, where do we get the highest returns? We wanted to test all of those settings when we tested it on the S&P 500 stocks over the last 10 years. And what we generally found is 2 things. Number one, when you're picking expirations, it's actually better to prioritize certainty, meaning knowing what's actually going to happen between now and expiration is worth something. It's worth more than the premium you're going to get if you do a longer dated call. Same thing for strike prices. What we found, it's more important to give your stock upside return or upside room to run before the stock gets called away over income. And this is really because you own your stock because you want it to appreciate in value. That's why you're owning. That's why you held on to that stock. So that's why we want to make sure that you give that stock some room to grow before the stock gets called away. And that's really one of the things that we found. So based on all of our findings testing short, medium, and long-term, conservative, optimal, or aggressive, we found that the highest returns were when you sold short-dated calls, so specifically weekly cover calls, weekly short puts, weekly credit spreads, that's really where you had the best yields on these types of strategies. And when it came to strike prices, we found that roughly about a 15 delta call, so somewhere between optimal and conservative, yielded the highest possible returns. And from that, we saw roughly about a 3% annualized return on that strategy based on the S&P 500 stocks over the last 10 years. So that just gives you a rough estimation of what you can expect from these types of strategies in addition to what you're currently seeing from the returns of your stock. So with that, let's actually show you OptionsPlay. Now that we've learned a few different things about selecting how you select your expiration date, how you select your strike price, let's actually show you how to implement that using OptionsPlay. So for those of you that are brand new, welcome. OptionsPlay is available to you here on the upper right-hand corner. There should be a tab that says OptionsPlay. If you don't see it, please contact your customer service rep. They'll be able to help you out with how to get started. Now, this platform is divided into 3 sections. We have trade ideas and watch list here on the left. We have our security analysis panel here in the middle, and we have trading and income here on the right. So today, what I have set up is a watch list, and I highly recommend for any of you that sell cover calls, cash secured puts, or even credit spreads, to set up a watch list with the stocks that you want to sell these strategies on, because it's going to make your life a little easier. And on this right-hand side, we have both trading for those of you that are looking for trading strategies to find bullish and bearish setups on any individual stock. But today we're going to focus on the income tab, because that's what we're going to talk about here, is how to generate income from cover calls and cash secured puts. So, and we built this platform to make options trading a little easier. I know many of you said that you're new to this strategy, new to selling cover calls. And if you've ever looked at an option chain like this before, you can find that sometimes this is quite overwhelming, going through all the different expiration dates, all the different strike prices to try to find which expiration date to choose, which strike price to choose. It's really overwhelming. And sometimes you simply don't know where to start. And that's really why we created OptionsPlay. We wanted to provide users a much easier starting point and provide you with all the analytics, because if you're on this page, even if you knew how to navigate this page well, and I can show you how to do that pretty quickly, so I can know that, hey, I might sell the 215 calls on August 31st. As an experienced trader, I still then have to figure out, 69 cents, that's how much premium I'm going to get. I'm going to still have to put that into a calculator to calculate yields. So there's still a lot of manual work, even if you know how to use the chains very well, that you still have to go through before you can actually decide, is this the trade I want to make? And OptionsPlay was designed to make all of that much, much easier for you. So I want to show you guys how to set this up so that you can instantly go from finding your cover call opportunities within just a few seconds. So on the income tab, before you do anything, at the very bottom, there's a button that says income settings. This is where we talked about short, medium, and long-term, conservative, optimal, or aggressive. This is where you can set your own preferences. Like I said, cover calls and all of these strategies is not a one-size-fits-all strategy. So it's really important that you select the time frame and the risk tolerance that suits your personal preferences. So we have short dated options, medium, long term. So I'm short term because of how actively I trade, and then conservative, optimal, or aggressive. Optimal is where my risk tolerance is. Now, for those of you that do cash secured puts, which I'm not going to cover as much on this trade, you can actually set these independently of each other. So when I sell puts, I like to get more aggressive on my risk tolerance, but when I sell calls, I like the optimal risk tolerance. So make sure that before you start any of these strategies, that you come into the income settings button, create your own personal preferences for how frequently you trade and your risk tolerance, and all you have to do is save as default. Once you do that, everything that we present to you in terms of a cover call or cash secured put is driven off of your own personal preferences. And what this is the automation piece that I'm talking about, is you no longer have to manually go through an option chain, find that 30-day option, find that 20 delta op call, and then figure out yields. It does all of that for you. All you have to do now is simply click on any symbol in your watch list. So let's take a look at Pepsi. fairly big blue chip stock that many of you may own in your account. And when you click on it, what it does is it goes out and it finds the cover call that meets your personal preferences. So here's Pepsi. At first, we'll ask you, do you own shares of Pepsi? So if you're selling a cover call, you would click on yes. If you are selling a cash secured put, you can click on no and be presented with the cash secured put. But let's talk about the call here real quick. So let's say you own 200 shares of Pepsi. What this allows you to do is take a look at where's your starting point. This is telling you to sell 2 contracts of the August 31st 118 cover calls. Pepsi's trading at 114 and change right now. So this is a call that's about $4 above the current price. And it breaks down all of the details of the trade for you. For those of you that are brand new to this strategy and you're still learning, what we try to do is break this down into plain English for you. So selling the August 31st 118 calls, it will generate $108 in income. They produce a 7.19% annualized return, and there's a 79% chance that this call will expire worthless. So we talked about, based on my personal preferences with Optimal, I want to find calls that have about an 80% chance of expiring worthless. So this did all the work for me and presented to me an option that was within my time frame, 24 days to expiration, an 80% chance of expiring worthless right in my range that I'm expecting for my cover calls. And all I have to do is look at the yield. So here, the yield is 7.19%. This is a Pepsi pays a pretty nice dividend of 3%, almost double what the S&P 500 is paying. So you're getting a pretty nice dividend if you own Pepsi stock at 3%. But this cover call gives you an additional 7% on top of that. That brings your total yield for the year to about 10%. So if you own Pepsi stock and you're currently only getting a 3% yield, would you like to potentially get another extra 7% on top of that? I think most people will say yes, especially because this is an asset that's just sitting there. You might as well utilize it to try to generate some additional yield. Again, this is why this is the most popular trading strategy with all options traders, hands down, because of this the ability to generate yield on the assets that you already have in your account without adding additional risk, okay? So this provides you with all the details. Simply click on a symbol and it automatically tells you your starting point, gives you all the metrics, and if you decide this is something you want to do, all you have to do is click on the trade button, and what it does is it pre-fills all the details for you. We even have a strategy checklist. This is for those of you that are brand new to make sure you understand your risks. So it tells you if you're the probability of this call expiring worthless. It checks the annualized return of the yield of the call. It checks for earnings date. This is something that we see a lot of beginners tend to overlook, making sure you understand your risks. And lastly, we look for spread and liquidity. We want you to know whether this option that you're trading is liquid or not liquid, so you know that beforehand, not after you place that trade. And once you've determined that this is a trade that you want to make, one of the greatest parts about the integration that we've done is that when you hit the preview order button, it pre-fills the ticket for the user, for you, so that you don't have to enter anything manually. Everything is automatically entered for you. So all you have to do is simply verify this trade and you can send this off for execution immediately from OptionsPlay. So what I want to do now is just spend a few minutes going through this list and showing you how easy it is to go through a full list of stocks and instantly know if there's a cover call opportunity or income generating opportunity on the stocks that you own or not, so that you don't waste any time. The last thing I want to do is for you guys to spend lots of time manually going through things, which opens you up for mistakes, opens you up for different emotions, and just simply sometimes is very time consuming. What I want to do is show you how you can click on a symbol like Netflix. Many of you may own this stock and maybe have taken a hit over the last few weeks, and you might be trying to recuperate some of those losses by perhaps reducing your cost basis. As you can see, I don't have to pull up an option chain. Netflix is trading at 350, roughly 350. This is telling me to look at the August 31st 375 cover call. So roughly $25 above the current price. And this basically means the stock needs to rally $25 over the next 24 days before I have to sell my stock at 375. And there's about an 80% chance of that happening. So as you can see, this this particular call yields a 12% yield. If you own Netflix stock today, you get paid 0 dividends. So you're getting no yield if you hold on to this stock in your portfolio. Here, you're getting an additional 12% on top of that. Would you like to get some additional yield on your portfolio? I think many people are interested in looking at potentially generating some income on their portfolio, especially on these tech stocks where you're not getting any yield on. Cover calls is a great way to potentially do that. And this tool not only helps you identify the opportunity, but also presents you all the information you need to know in order to place that trade. And once you're ready, you hit that trade button, preview order, and pre-fills the ticket for you, and you can send this off for execution instantly. So let's just go through a few more examples. I have a bunch of stocks in here that many of you may own in your account. Let's look at Microsoft, trading at 108. This is telling me to look at the August 31st, 113 calls. I never have to pull up an option chain. I don't have to go through and scroll through all of that. It tells me exactly where my starting point is, provides me with all the information. Microsoft pays a 1.5% dividend yield, a very average yield. But this cover call that I'm looking at pays a 5% yield. So an additional potentially up to 5% a month, a year on Microsoft by holding on to, by selling cover calls on the stock that you already own. So very interesting way to add additional yield to your portfolio if you have these stocks in your account. Amazon. Maybe Amazon is a stretch. I don't know how many people have 100 shares of Amazon, but if you do, it's a stock that you get 0 yield on. So by selling cover calls on this, Amazon's trading at 1862 right now. This is telling me to look at the 1940 cover calls. So this is yielding $8,000 in income. Again, this is a very high-flying stock. You need $186,000 to own 100 shares of this stock unless you've owned it for a long time at a lower cost basis. In that particular case, you can earn an additional 8% on this stock. This is why we want to look at these types of strategies to help you add additional income to your portfolio. Let's take a look at Apple. This is probably a more realistic stock for people to have 100 shares of. Apple trading at 207 right now. This is telling you to look at the August 31st, 215 cover call, so roughly about $8 above the current price. This yields 5% on a stock that only yields you a 1.4% dividend yield today. So 5% yield brings your total yield to 6.4%. So you're increasing your yield from 1.4 to about 6.4. This is, again, why this is one of the more popular strategies amongst traders, because it allows you to add additional yield to your portfolio with the existing stocks that you hold in your account. Let's look at Intel, 49.70, telling me to look at the August 31st, 52.5 cover calls, so roughly about $2.50 above the current price. Gives me a 7.96% yield on a stock that pays a pretty nice 2.5% dividend, which brings my total yield to 10.3%. So it jumps from 2.5 to 10%. These are the types of opportunities that you'll be able to find by adding cover calls to your portfolio. And as you can see, I can go down this list very, very quickly and within a few seconds know exactly which stocks have opportunities, like Verizon, which is trading at 52, tells me to look at the August 31st 54 cover calls, so roughly $1.50 above the current price. And this allows you to just, without having to spend much time, instantly see if there's an opportunity on AT&T. So as you can see here on AT&T, the message is a little different. On all the other strategies that I've shown you, you get this little green check mark. What that means is that we were able to find you a cover call based on your personal preferences. However, on AT&T, it tells me it could not find me a call based on my short-term optimal preferences, so it's displaying to me the next best alternative. In this case, it's a long-term optimal. For those of you that are brand new to brand new to cover calls, this is really just telling you to potentially avoid selling a cover call in AT&T. This is also designed to save you time, because you may pull up an option chain, type in AT&T, then you go through the short-dated options, perhaps you find nothing there, so then you go through the long-dated options, and you end up spending a lot of time looking for something that may not exist. And what we're trying to do is prevent you from doing that. If you see this message, this tells you, hey, there's no opportunity opportunities here on AT&T, let me move on to the next stock. Let me look at Goldman. Goldman's trading at 237.83. And then within a few seconds, I know that which cover call I should look at, the August 31st 245 cover call. So about $7 above the current price, giving me about a 5% yield on a stock that pays only a 1.3% dividend, giving me all the information that I need within a few seconds to decide, is this a cover call I want to sell on Goldman Sachs? And this is designed so that you can go through a list of 20, 30, even 50 stocks, and within a few minutes know which cover calls that you might want to sell, not the hours it used to take to do this type of research on a list of 20, 30 stocks. And this is really designed to save you time so that you don't have to spend all your entire day in front of your screens finding your cover calls, and really making your life just a little easier through automation. And this allows you to go through a big list, and every single Monday after options expire on a Friday, you can come in on Monday, use this tool, figure out which cover calls to sell those cover calls, and come back the next, once your options expire and do the same thing. And what we really want to do is make that process of selling cover calls over and over again, which is how you generate consistent income in your portfolio. We want to make that a reality by making this process as easy as possible for you. We hear from a lot of cover call traders, kind of finding that the research time just takes so much time that they're not able to spend the time every single week or consistently generate income because of how much time it takes. This really is designed so that you really don't have much time to spend. You can go through a list very, very quickly, execute those trades, and just be able to come back every few weeks and be able to sell those weekly options and really generate the income that you want for your portfolio. So with that, what I want to do is I just want to jump back to our spreadsheet, the slides, and I promise talking a little bit about once you're in a cover call, how to manage them. These are the general rule of thumbs. I'll go over each one, and then what we'll do is we'll open this up for Q&A. So first of all, when you sell a cover call, there are basically three scenarios that can happen. Number one, you can have the stock shoot higher, you can stock that move sideways, and you can have the stock move significantly lower. Those are the three scenarios, and I want to cover generally what to do. So in the first scenario, if you sold a cover call, so let's say we go back to the example of Lockheed Martin, it's at 317 right now. You sell the 330 calls against that, and let's say the stock shoots up and then goes up to 335 or 340. This is really where we see a lot of people tend to panic, because what you have is you have a pretty nice gain on the stock, right? You own the stock from 315, now it runs up to 335 or 340. You made a pretty nice gain there, but what you see is this unrealized loss on your cover call that you've sold. And this is where we see some people panic. And what we tell people here is don't panic. The best thing for you to do is simply hold on to your cover call. And if you need to get out of your cover call, you can roll your cover call in the last week. And what I mean by rolling your cover call is simply buying back the call that you've sold and selling another one in the future. So right now we're telling you to sell the August 31st 330 calls. Let's say the stock shoots up to 335. Best thing to do is don't panic, because number one, the stock can potentially come back below 330, which negates the need to do anything. And then, if it stays above 330 in the last week of expiration, what you can do is you can buy back the 330 calls so that you don't have the risk of selling your stock. And then you come back to OptionsPlay again and sell another call. At that point, you might be selling September, maybe 350 calls or 360 calls, whatever it is that OptionsPlay tells you to do, you simply sell again. That's what rolling a cover call means. It's buying back the call that you've sold before and selling another one. That's what we mean by rolling it. Now, you only want to do this in the last week. You don't want to do this prior to expiration date. So make sure that you hold on to that trade and roll it only in the last week. The second scenario is kind of your best case scenario. You sold this this Lockheed Martin 330 call, and the stock just goes sideways. It stays around 317, 320, 315, somewhere in that range, because what that means is that you keep all the premium that you've collected on that 330 call. You keep all of it, and that's just income in your portfolio, and you haven't made or necessarily lost any money on the stock, but you did receive income on the cover call. Last scenario, this is kind of where, let's say you sell the cover call at 330, the stock's trading at around 315 right now, and let's say the stock drops. It drops down to 300. So now you have a loss on the stock, but what happens is the cover call that you've sold, most of that income will be realized almost immediately because there's almost no chance of the stock going above 330 by expiration in the next couple of weeks. So what's going to happen is this is where the only scenario where it makes sense to roll your positions early. So again, you want to come back to OptionsPlay. So, and the rule of thumb here is you want to buy back any calls that you've sold earlier. If you can buy it back at 20% of the original premium or less, that's when you want to buy back your call and sell another one. So if let's say we're selling this Lockheed Martin call, and as you can see, it's trading at $1.15. So let's say you collect a little over $1 on this trade. So once this cover call or this call is worth 20 cents or less, so 20% of the original income that you received, if you can buy it back for less than 20%, that's when you want to buy it back and maybe sell another one. So if this stock drops down to 300 next week, this call will be virtually worthless, and you can basically, you sold it for 115, you buy it back for 20 cents, so you collect the 95 cents that you've made on the trade, and you can sell another call immediately right after that. So that's where you want to consider what we call roll down the position early. So those are the three general scenarios that you might encounter when you sell a covered call and how you should handle each one. So with that, I just want to quickly summarize, when you're using OptionsPlay, first of all, it's available to you on the upper right-hand corner here. You have trade ideas and watch lists here on the left. I highly recommend you to set up a watch list with the stocks that you own to make this process as easy as possible. And before you use the income tab, make sure that you use the income settings to set your settings for calls. And for those of you that are selling puts, make sure you set these appropriately for cash secured puts. Save as default. And after that, every single stock that you click on, what will present to you is the opportunity to sell covered calls and cash secured puts based on your personal preferences. And this is designed to make your lives a lot easier through automation. Saves you on making mistakes, and also just saves you a lot of time from going through pages and pages of those chains to figure out where you should start every single week. So with that, thank you very much. I will open this up for Q&A. If you have any questions, please type them into the chat window, and I'll be able to answer as many questions as I can. Looks like I have a question here. Do you do weekly cover calls? Absolutely. That's really kind of what we're trying to cover here. Is the short dated options is really where you're going to get the best returns on these types of strategies, because theta really accelerates, or time decay accelerates in those short dated options. And by selling short dated options, that's when you're truly able to capture as much of that theta or time decay as quickly as possible. So yes, we do weekly cover calls through the strategy. In order to do that, you just make sure you use income settings and click on the short time frame for that. Any other questions? Rick, can you construct an order to buy stock and sell call in the same order? Yeah, you can. So let's say you own shares of of Boeing. Let's say you own 0 shares. When you click on the trade button, let's see, what's the best way to do that? Oh yeah, so you would just add stock here, and you can add 100 shares of that stock to your strategy here. You can do that on the trade ticket. There's 2 buttons. One says add option, one says add stock, and you can do it on your trade ticket. Ronald, how can I do that? I'm not sure what you mean, Ronald, in terms of how can you do what? Mark's asking, does this only work on high-priced stocks? Great question. So it does certainly work better on high-priced stocks, but on lower-priced stocks, you still can do this. So let me find a lower-priced stock here. AT&T is probably a lower-priced stock, but let me see if I can find a lower price stock. The only problem with lower price stocks is sometimes the strike prices are so far apart from a percentage standpoint, you just can't quite find the right fit. So sometimes it comes down to luck as to whether or not you can find a right opportunity on cover calls for, so here's a $43 stock, relatively lower price stock. As you can see, the The income here is $15, so it sounds like not a lot, but if you see the yield here is 4% on a stock that only pays a 2.5% dividend. So $15 doesn't sound very much from a dollar perspective, but if you probably own more shares of a lower price stock, so let's say you own 300 shares of this, then you're receiving $45 in income, which is still 4% yield, which is a nice bump from the 2.5% that you're getting on this lower price stock. Can I sell a call and buy one for insurance? What do you mean by buy one for insurance, Emmanuel? I'm not sure what you mean by that. Ronald, I'm not sure what link you're referring to. I'm sorry. Kevin, can you briefly describe the annualized return calculation that OptionsPlay runs for you? Sure, absolutely. So let's try to take a stock. I want to take a stock that's near $100, and that's easier to calculate or to illustrate here. Let's look at American Express trading right around $100. So American Express here, as you can see, this gives me a $48 in income for a $100 stock. That's why the raw return here is roughly 0.47%. So meaning you're going to collect $48 out of $10,000. That's 0.47% for every 100 shares, and that's over the next 24 days. So what we do is we annualize that number over the full year, and that's how we get to the 7%. So we take the raw return, which is roughly 0.5%, and we're basically saying if you're able to replicate that throughout the whole year, what does that annualized return come out to be? And that's how we get the annualized return of 7.16%. How do we access this platform? Great question. So there's an OptionsPlay tab in your upper right-hand corner, and if you don't see it, you can click on Add Widget, and there should be one for OptionsPlay. If you still don't see that, please contact your customer service rep. They can help you with that. Dennis is asking, how do you set stop loss? That's a great question. That's a question for your brokerage firm. We're just here with helping you find the trades. As far as managing your orders, your brokerage firm should be able to do that. So please contact your customer service rep. They'll be able to help you with how to set up a stop loss on a trade.
Hey, Tony. Ronald was asking originally, do you do weekly covered calls? Because he'd like to see it again and how he can do that.
Yeah, so we've covered that, right? So it's as long as you select a short-dated option, so short-dated options for calls or puts, that's how you're going to get weekly cover calls. Can you tell me the difference between cover calls and sell a call without shares? Absolutely. So you can certainly sell a call without the shares, but you're going to have to put up a huge maintenance requirement or maintenance margin requirement to do that. And if the stock gets called away, you better have the stock to deliver. So meaning you better have the money to buy the stock and sell it to someone at 105. So here with American Express, if you own the stock and you sell the August 31st 105 cover calls, then if the stock goes above 105, you just take your 100 shares and you deliver to that person that you sold it to for 105. If you only sold the call naked, meaning you don't own the stock and the stock gets called away, then you have to now buy 100 shares of the stock at whatever price at the market is, then deliver it to that person for $105. So that's a difference. Most people don't have the ability to sell naked calls anyway, but if you do, that's the difference between the two. And yes, the loss is unlimited in the second case. The loss is not unlimited when you own the stock, because whatever losses that you have on the call will be offset by the gains that you have in the underlying stock. That's why we call it a covered call. Any way to insure against losses when you own the stock and have sold the call, but stock has a major downturn? So one of the ways that you can do that is a collar strategy. So you can sell this cover call and actually take the income and buy a put with it. So if, let's say you own American Express at 101.97 and you want to buy some protection for it. You can buy, let's say, a $95 put. Let's say that costs 44 cents. And what you can do is you can sell let's say a 105 call against that. for 109. So this allows you to buy some protection while generating some income. That's what we call a collar strategy. Sorry, this is a buy and this is a sell. So this is a collar strategy. You might want to change your strike prices. So maybe you can buy a 97.5 put for 76 cents and then maybe sell a 105 call for 99 cents. So this brings your almost net to your net almost at even. So this allows you to have some downside protection while offsetting the cost of that by selling some calls against it. So that's one of the ways that you can insure against losses on a stock while selling some calls. Can you use OptionsPlay while in live trading platform? Absolutely, you absolutely can. If I'm not mistaken, this may only be available in the live trading platform. I'm actually not 100% certain. So please call your customer rep, but it's definitely available to you in your live trading account. You're welcome. Any other questions? And another thing that I kind of just want to touch up on, sometimes I get this question, and this is a fairly common question, is what if you don't have enough money to buy 100 shares of a stock? And this is actually a pretty common thing that I get, especially for those of you that may not have 100 shares of stock in your account. One of the things that you can do is you can replace 100 shares of stock. So as you can see, 100 shares of American Express cost $10,000. So some of you may not have $10,000, but you still might want to have, number one, bullish exposure in American Express, and one of the ways to do that is buying a long-dated option. So let's say you buy a January, let's say an $80 call. That costs you only $2,675, so about a quarter of the price of a long stock option. But it gives you, as you can see, almost exact same payoff as owning the stock. And it gives you limited risk. So no matter what happens here in American Express, you could lose up to $10,000. But here on the call option, you can only lose $2,600. So you get the same upside exposure, limited downside protection to the downside. And what you can do is you can sell cover calls against the leap that you own. So that's one of the strategies that we call a poor man's cover call. So if you don't have 100 shares of the stock, but you still want to trade the strategy, buying a deep in the money, long dated option is one alternative that you can have to buying 100 shares. It'll usually cost you anywhere from 10 to 20% of the underlying cost. So here it'll cost you roughly 25% of it. So a quarter of the price, you can trade similar strategies, and we call this a poor man's cover call. Any other questions?
Okay, I think that about wraps it up then. So thanks, Tony, for going through everyone's questions. And I do see, how often do you have trainings like this? We have our OptionsPlay webinars. We try to have them once every 2 weeks. And so we have, I'll share with you the date. I think it's August 11th, which is or August. I'll have to check the date here coming up. But we have another webinar coming up here pretty soon. Let me see so I can answer this gentleman's question here. August 22nd. There we go. Wednesday, August 22nd is our next OptionsPlay webinar. And so be on the lookout for the next invite for that. If you've registered for this webinar and past ones, you'll receive an invite for that next one on the 22nd. But anyway, yeah, thanks again, Tony, for showing us all the income strategies and covered call. That was really great stuff, and going through everyone's questions. And thank you all for attending as well. And thank you for your questions and your participation. We really appreciate it. This is being recorded, and so if you did sign up, we will be sending out a link to the recording, so please be on the lookout for that. And if you have any other questions, please contact your brokerage customer support, and they'll be happy to assist you. Okay? Thanks again, everyone, and have a great afternoon.
Thanks,
Bye-bye.
everyone. See you guys in the next couple of weeks.